Hey, what up everyone? Welcome to Tuck Notes, Beginners Talk. Coming up right now, I'm going to just cover Tesla, overall stock market, kind of what happened, what went down today, and how this whole week kind of unfolded downward, including Tesla and every other stock, pretty much, and what to be on the lookout for next week. We have some important economic data that could affect the stock market significantly, like it did the last time we had economic data. So, and we'll see how much that will affect the market too. So, we'll also hear from an analyst about why right now is like kind of once in a generational lifetime time to buy these big tech companies on a big discount. So that's that. We'll hear that. But moving on, Tesla so closed at 769.59. Was up 5.71%, which is $41.59. The week it was down 12.89%, and we went up 5.7. We went from 850 to 680 in 1 week, and 680 could be the bottom. We broke through 700, which was our support resistance area line, and then we bounced back up above 700. On the news wise right now, there's a tweet that Elon made saying that relatively a total of the fake accounts that are on Twitter is 5% right now. I guarantee this number's going to creep up more and more and more and more based off of Optimus. But what do I know? It could be something else. Also, we have next week our retail sales number and our initial jobless claims. These were things I totally spaced out on before because I didn't think they mattered, and they actually do matter, and so they will impact it. That will be on Tuesday, so expect some movement on Tuesday of either up or down. If Tesla key price point level right now for Tesla is 700, we got to 680. Or actually, I'm sorry, let me say it's like this. For next week, let's watch our price point level. If we have a continuation on Monday, we could see Tesla going from where it's at to 750 up to potentially $800, and then close out. Or flip-flop, we could see continuation going downward on Monday and Tesla going from where it is to $730, and it'll range between $738.88 and $769.59. And so I'm going to show you guys a video right now about why this analyst, Dan Ives, which people think is the top analyst, thinks that this is a generational moment right now to get in on these big tech companies like Amazon with their splits coming up, Google 20-1, and his take on it, much better intake than mine. So let's see what Dan has to say.
Really think this is a generational buying opportunity? Well, I think for the right stocks, but because our viewpoint covering tech since late 99, in these downturns, you got to separate the froth from what we believe are the names that are going to be able to navigate and valuations that we believe are way oversold. So I look at software, cybersecurity, I look at names like Microsoft, you look at names like Amazon, Apple, among others. That's why to us, we're not just going to sit here and say you paint them all with the same brush. It's a bifurcated tape.
Okay, let's talk about the mega caps specifically. Because who's to say that these stocks deserved to be where they were before this recent sell-off? I take a look and I raised this issue, and I asked our team to put these numbers together because I wanted to raise this with you. If you look at where the PEs were for all of the mega cap all-stars, right? From the pandemic low, let's call that March 2020, okay? Apple's PE was 17. All-time high S&P, it got up to 30. Microsoft 23 got to 34. Alphabet 22 got to 25. Meta from 18 to 24. Nvidia from 27 to 58. The point being that a lot of these stocks, if not the whole group, got that burst because of all that the Fed was doing from liquidity, right? Now that the Fed's pulling that liquidity away, why shouldn't these stocks go back to where they were around the time that the Fed injected this liquidity? These stocks didn't run up in the manner in which they did on fundamentals, did they?
And that's a great question. That would be a big debate. And ultimately, I just view it as fundamentally, when I look at the trends over the next, call it 2-3 years, when I look at the cloud trends, I look at semis, I look at AI, I look at what I believe is the fourth industrial revolution. You stress test these numbers. Look, this is the fundamentally different. The buy side, they're already looking now at 2023 numbers, assume mild recession ahead of the sell side. So my point is that numbers here relative, I mean, if you look at MFANG from an EBITDA perspective, I mean, 12 times, you're starting to look toward what I go almost be market multiples for what I view as probably the best growth names across tech.
But see, like these stocks were used as, in some respects, bond proxies. In, I think, a large respect, defensive plays in an uncertain world during the pandemic. Can you make the argument to me today that Apple deserves to be at a 30 PE? Or does it deserve to be closer to the 17 where it was before the Fed put all of the punch in the bowl?
Okay, so that's a good example. Let's just look at Apple.
Yeah.
The services business is a different business today, and I believe going forward, than it was 2 years ago. So you're talking about an $80 billion revenue stream that basically has been a big part of the re-rating in Apple. And it's always been my contention, Apple's a name. When you look at it as straight PE, instead of some of the parts in terms of looking at services and hardware, you ultimately, what I believe is, undershoot what should be the core valuation. So my point here is that I'm not saying the froth, the web vans, the global crossings, what we saw in 2000.com front and center, that's not going to happen. I'm just saying you have to separate the have and have-nots and valuation here relative to when we go back to 08, 09 and even 01, 02 relative to growth. We view now as the time for the names that we've talked about in our tech playbook to own them.
But is Apple's services business 13 points of valuation better than it was 2 years ago?
Well, I think, and I think when you look at Apple services business, you look at the growth, you look at ultimately the margin on the services piece. I think it's something going into the pandemic, the market was basically assigned, now it's worth $400 billion. And at one point in the pandemic, we're looking at 1.5 trillion. So I think a big difference with some of these names, I'd argue the same with Amazon. Some of the parts, what's the cloud business worth? With Google, I'd argue right here, you're assigning minimal growth and minimal valuation to the cloud. You stress test numbers on the other side of this, get every bear argument out there, but it just comes down to, like, Scott, we've talked to 25 of our checks this week, CIOs, product managers trying to understand spending.
And so that's where we're going to end it at. I hope you guys have a good night. I hope you make the right decision and the right company. Go with what you believe in is going to make the future, as Elon would say. Believe in the company. Go with the companies that you believe in. All right, late.